May I invite Chris and Magdi back up on stage together with François, and then I'll open for Q&A. Okay, who hasn't asked a question for a long time? Mitch?
200 basis points of structural cost savings. That is on top of the continuation of the other programs, which I think were 500 basis points over the prior 3 years.
Yes, on the top of the structural savings are on the top of what we have delivered and what we expect to deliver in the future as far as NC is concerned.
And you can't add any colour on how much of that you would expect to flow through into margins?
No, as I said, I think it's too premature today to say exactly the way we are going to allocate it between reinvestment behind our brands, competitiveness, and operating profit. We'll come back to you later on. It is still early to do that. We have been working on really focusing on identifying the structural savings for the time being, and we'll come back to you in due time. I don't expect, just to be clear, whatever I've shared with you will not have any impact on the guidance that we provided as far as 2016 is concerned.
And the other programs have a similar quantum to go over the same time period, or as they achieved over the prior 3 years?
But we have started already some of these projects. For example, on procurement, we have already started. Most of the other projects we are really starting as we speak. Expect that, as I said, there will be a limited impact in 2016. We will be really in the implementation phase and execution phase in 2017 and 18, and we'll get the full benefit in 2019. We should get some benefits already in 2017 and 2018.
Thank you.
Who's next? Jeremy.
Hi there. Just another question linked to these additional savings you've got. Is there likely to be any sort of increase in your restructuring costs? And again, could that mean that if there is any sort of benefit that flows down to your operating margin, it's going to be pretty back-end loaded? Thanks.
I don't expect to have any impact as far as one-off cost in 2016. We already have anyway in our budget and in our yearly budget some provision that we had already integrated in our communication and in our guidance. So I don't expect any impact for 2016. For 2017 and 2019, we'll come back to you. Be aware of the fact that anyway, traditionally in our budget every year, we are already building in some one-off costs to start with. Second, some of these projects will not require significant one-off costs. And if I take the example of leveraging on scale on procurement, a lot of it is actually achieved without any significant one-off costs. And some of it will certainly require some costs, which we can absorb through the saving that we will get. But we will come back to you on due time in 2017 and 2018 on the exact amount. But once again, for 2016, I don't expect any significant impact.
Adam?
I fear you're going to get question after question on this, but just to be clear, you've announced a cost savings program, or savings programs, which is an acceleration of the existing programs. You have said that it's too early to allocate it between the brands, building, the competitiveness, and the margin. But that implies that if any is allocated to the margin, we should probably expect an acceleration in margin growth in 2017 and 18 compared with the 27 bips you've done in the past 5 years. Or am I reading that wrongly?
Well, first of all, I'm not saying that this is an extension of the former program, because as I said, NCE has essentially to do with operational savings. We are adding structural savings which have more to do with the way that we are working. I'm not changing any guidance. Anyway, we give a guidance only for a given year, which is 2016. I'm not saying that we are providing a specific guidance for 2017 or 2018, neither on the top line nor on the bottom line. We'll do that on due time. This is not the right time to do it. We'll do that later in the year.
But can I just, the feeling the market has is that historically Nestlé has done modest margin growth, which has historically been 20 to 30 bips. Closer to 30 than 20, but that's what it's done historically. As you said, this is an incremental program. Surely that implies, or are we, we have to sort of come out of this with a feeling, is that margin going to accelerate, or is it going to continue at roughly the same level?
Once again, I mean, I'm not giving any guidance as far as the medium term is concerned. I'm just saying we have identified additional savings in order to support our growth, and part of it will be, I gave you the three main uses of these savings, which is support our brand, secure our competitiveness, and the bottom line as well. I'm not talking about the distribution between these three concepts of this saving program because it is premature to do it.
Thank you.
I know that you would like me to be more specific, that's very clear.
So if it's the same question again, then hands down. If it's a new question, keep your hands up. John.
Well, it's sort of the same sort of question.
All right, Jerry.
I won't open with that opening line, but in terms of how you choose to allocate the money in the future, will that be done on the basis of an aim, given the current macro backdrop, which we all think is going to continue for a while, of growing the top line of 5 to 6%? Or do you think the business may reappraise what is achievable in the current macro environment with perhaps an implication of how much goes on to the margin?
You know, you touch a point which is interesting, which is one of the reasons why I'm saying it's too premature to give indication, because there are a lot of forces that are changing as well. When I talked about, for example, commodity pricing, I forgot to mention that we started to see some signs over the last 2 quarters of rebounding in terms of commodity pricing. So obviously this will have an impact on our cost structure. This will have an impact potentially on our top line as well, because we may be in a position to pass on price increases to consumers in a certain number of instances. So, which is the reason why, for the time being, we are focusing on delivering what we have said that we will do in 2016. We have a commitment, we'll meet the commitment. We are working hard in order to accelerate our saving program or efficiency program with a fairly wide scope, because it involves activities like manufacturing and operations, procurement, G&A. Let's work on that. After that, okay, we'll come back on due time with a view on what it means for the top line. But clearly, what is important as well is what you saw yesterday, what you saw this morning. I think that Nestlé is in the business of innovation. We have a lot of innovation platforms coming from R&D, coming from marketing, coming from technology and so forth. We are extremely confident that we can drive innovation even further than what we have done so far. What does it mean for the medium term in terms of top line growth? This is not what I want to discuss today, because this is not the right time to do that. I think the good news is that we have identified capabilities in order to free up additional resources. After that, the destination of these resources we'll discuss later as far as 2017 and 2018 is concerned.
So I'll come back again. Basically, just to really clarify, so you mentioned the 2.5 billion Swiss francs in the first presentation. That's the 200 basis points you're alluding to improvement, and that really comes on top of the 1.6 billion you're doing already. So add it all up, it should be like over 4 billion in savings, yeah? Is that the...
yes, I didn't say 2.5 to start with, but
no, in the
200 basis points on the top of
yeah.
the 1.6, but I didn't say that the 1.6 will deliver, but I said the 1.6 is what we have delivered over the last 2 years, and I'm personally extremely confident on the fact that we should be able to sustain that level in the future. On the top of, yes, it is on the top. The more than 200 basis points is on the top of the 1.6. By the way, the 200 basis points is for 2019, 2020. This is not for 2016 or 2017, obviously.
Warren.
Hi, it's Warren Ackerman at SocGen. A question on the ROIC. Obviously, very interesting chart on the 30% pre-goodwill and 10% post-goodwill. What do you think the ROIC can do on a pre- and post-goodwill on a 5-year view? And what will be the biggest categories or geographies where you see the biggest ROIC upside?
Well, I don't want to give any guidance on ROIC, and certainly not after goodwill, because it is largely influenced by potential acquisition that we could make. And I'm not commenting on any acquisitions anyway. Obviously, on return on invested capital before goodwill, we are all working in order to improve the ROIC. Once again, if it had not been for exchange rate last year and for the significant revaluation of the Swiss francs, we would have been up again. So we are acting on all levers on the operating side in order to make sure that we get there. I'm personally confident on the fact that because we are good at operating our business and we are acting on all levers from sales growth to margin improvement, regular margin improvement, working capital decline. And working capital, I'm very confident on the fact that we can improve as well. And because we have clearly identified what can be done on payables, on inventories, and so forth. On the asset base, we have a fixed industrial asset base. You can see that what Magdi is working upon will certainly help as well, because by increasing the asset intensity, I'm not announcing that we will spend less on capex, but obviously this is a good contributor as well in order to improve our return on invested capital before goodwill.
Cedric.
Hi, it's actually Eddie Helgreaves from Canaccord.
Sorry.
Just on, given the focus on cost savings and thinking back to Wan Ling's presentation, when you entered the JVs in China, I think the idea was that you would sort of get to know each other, establish trust, and then perhaps develop that relationship. Would there not be pretty significant savings in buying out those JVs? Why would you not do that at this stage?
I don't think that buying out our partners. First of all, it's okay. We have shareholder agreements with our partner to start with, and I'm not really sure that this would be a strong driver of synergies actually, because if we have a partnership which is working well, it doesn't prevent us from accessing to synergies as well. Our partner can benefit from what we develop with Globe, or they can benefit from what we develop on the industrial side as well. So we don't need to buy out the minorities in order to get there. By the way, the same applies for, the public companies we have in India, in Nigeria, and so forth. So I don't think that the capital structure of our affiliates is a must-have in terms of full control in order to deliver synergies. I don't know unless you have, but you know the case of Malaysia, for example, I think fairly well as well.
Everywhere we have 5 markets in the world where we are publicly listed, and we do not treat this any differently from an operations perspective with all what we, so.
Eileen, please.
Hi, 2 questions, please. The first one is on working capital. I know you said that you can never get to negative working capital, but can you just explain why you're so convinced on that?
Well, first of all, we are still far away from it. But no, the example I give very often, which is it depends a lot on the categories you play in. If you're in fresh dairy products, we are not very exposed to that category directly, at least in our consolidated financial statements. If you're in fresh dairy product, you have structurally a negative working capital by 10% because you are in the fresh dairy product. So as soon as you produce, you have to sell immediately. You have zero inventory. If you're in the water business, as we are, for example, you don't want to have plants in order to meet the demand at peak during the summertime. So what you do is you start producing in February or March maybe. You pile up inventories in order to be able to meet the demand in the summertime. When you're in the ice cream business, to a large extent, it is the same. So structurally, we are playing in some categories where we need to have more inventories, for example, or we may need to have specific terms as well in terms of payables. Frankly speaking, we could get there at a cost, which I don't want to do. I want to make sure that if we get there one day, I'm not totally eliminating that possibility, but if we get there, I don't want to get there through artificial means, I would say, which is, for example, by factoring our receivables, because it has a cost. So I don't want to do any trade-off between our balance sheet and our P&L. So if we can get there on an operational basis without compromising between our P&L and our balance sheet, we'll get there. But still, okay, we were at 4.7% last year. Okay, let's go first below 4 and then below 3 or whatever, and we'll see. But I never want to make any commitment that I can't meet. Ideally, I wish I could be there because it's a fantastic story to have a negative working capital, because not only do you generate cash by selling your products, but you generate cash through your working capital in addition to that. But okay, we are not there yet.
Heidi?
I have one question for Magdi on his presentation. I was wasn't, if maybe if you could clarify just on the asset intensity savings of 1 billion, is that a capex saving or is that an opex saving?
No, this is a reduction. It's not an avoidance of capex. It's a reduction in conversion costs. So that was a net saving that you saw there, and it's about utilizing better the lines, stopping reducing the breakdowns and all that type of things, which comes with waste and costs. That's what it is about.
So the plants will have bigger capacity, but also less waste. So it will be partly capex, partly opex.
Yeah, as I think François alluded to that when he linked also the capex in future with the increases in asset intensity, it will have also a side effect on that, which means that by continuing to invest the same, we would have even a better or bigger opportunity to manufacture more things.
But to be clear, NCE is OPEX only. The NCE is just cost. NCE does not include CAPEX. Huh? So OPEX.
Correct.
Pierre, I think you had your hand open for a while.
Thank you. I have two questions. One on your M&A criteria with ROIC above WACC over 5 years. Do you think that today, in current times, there are opportunities in terms of valuation ratio to find targets with ROIC above WACC within 5 years? And does that mean that you are guiding on no M&A at this stage, or do you think that in coming years we can have declining valuation ratios in the M&A side in the sector?
No, I'm convinced personally that we can deliver an ROIC superior to the WACC within 5 years. It depends. It's very difficult to make a general statement there because it depends on the story. Is it a growth story, which is one way to get there? You can have, I don't know, if I look at one of the latest acquisition we made with Merrick, it is clearly a story of growth. So we can deliver this return on invested capital above the WACC within 5 years through growth. There are other cases where it's a synergy story. It's a cost synergy story, which is something totally different. There are cases where when it's a mix of both. I think that this rule of ROIC superior to the WACC within 5 years is a healthy one. First of all, I can tell you it kills quite a lot of projects that we may have. It requires a lot of discipline as well to make sure that we don't build a case over the next couple of years in order to get there. So we need to make sure that we build a case that we can achieve from an operational point of view and that we can meet these financial criteria. After that, the multiples, fine. If the multiples are too high, then let's not do it. But we can always make exceptions as well. We can always have strategic views on a certain number of acquisitions. But I want to be very careful with the concept of strategic views on an acquisition, because if you start saying, no, this acquisition is strategic, there is a strong likelihood that we won't get a return for it. So we can do it by exception, but it should not be the rule. It may happen from time to time that there is a specific asset that is important for you to get, which could be a defensive position, for example. But I think that this is a healthy criteria, in my opinion, as a general rule.
I have a second question on as a follow-up on your working capital remark relatively to your business. Do you think that over the last 3 years, the declining rates has probably lower barriers to entry in your specific businesses requiring high level of working capital, because it's easier for new entrants, probably in beverages and high incentive business in terms of working capital to do business?
In terms, if you take the example of water, I mean, the part of it is a commodity business because this is water. So we are not in the commodity business because we are in the branded business of water. Marco said it very clearly yesterday. We are very selective in what we do in water. So which means that, for example, in many countries, we do not go into the part of the business that competes with private labels because we know that there is no return for us. So we are extremely selective in that. When we are with Perrier, with San Pellegrino, we are in the premium or super premium business. Then we have strong local brands on which we have an appropriate level of pricing. So we are very selective in water. Marco mentioned it very clearly yesterday. We have 11% market share. We are not looking at market share for the sake of getting market share. By the way, you may know that in water, for example, we have lost somewhat a little bit of market share by choice. Why? Because there was no return in a certain number of instances. But that doesn't mean that it's a negative category in itself. It's a very good category because it's a category that offers good growth opportunity, which is what we experience. It's a category that has been strongly accretive recently in terms of margin improvement for Nestlé. It's a category that is generating a level of cash flow which is higher than the average of Nestlé. So we are very happy with that category, but we need to be careful in, I would say, sub-segment of that given category.
Robin?
Just a question about the shared services. We've all seen the benefit of these as they're introduced into companies, but could you just talk about the risks that you see introducing it, particularly within Nestlé, which is obviously a very decentralized business, where you have the local managers, the local flares, the business heads, etc. Just address some of the issues that you see that could be negative. Thank you.
Yeah, so as I mentioned before, I mean, you know, shared services aren't new. I mean, we've had them since 2005. I think the big difference now is that, you know, it was an opt-in model, and if a market would be able to choose whether they wanted to join, they make a business case. If they felt the business case was worthwhile, then they would join in. And you can imagine in a company like ours, that the adoption wasn't maybe as high as it could be. It is a different approach now. It has been identified clearly that certain activities will be moved to shared services. There is no discussion. There is no business case being done by markets in these particular areas. So this is understood. My concern, I guess, would be, first of all, that we need to ensure that we have even a higher level of standardization with respect to processes. If I look at Globe, and if you just look at lines of common code, we have about 75% lines of common code across our Globe template. In order to really have interoperable shared services, we actually have to increase the level of the level of standardization, which is what we're doing with these workshops and new designs that we need to do. So we have to make sure we get and hold firm to standards, because that's a little bit hard also in a company like ours. You always want to maybe sort of adjust things slightly, and if you do that, very difficult to have the interoperability. The other thing we have to be very, very strict about is that when activities are moved to shared services, that the structures in markets are dealt with in the appropriate way. That's extremely important, and that's something that we'll be following up on, of course, very, very carefully. But at the end of the day, one of the big benefits of moving activities like this to shared services is the majority of these transactional activities, will be automated, or can be automated now, or will be automated into the future. And if we don't actually move them out of the markets into a central area, we're not going to be in an ability to automate across 160 different countries. So that really sets us up as a platform for the future for automation. But those are sort of like the risks and benefits that I see.
I would say, again, one more. You had your hand up for quite a while, please.
A question on your innovation rate, which I think you said had picked up a little bit to 31%. What's your aspiration as to where that can get to? What do you feel is the optimal level for that? And I guess a similar question to the statistic you provided over the percentage of business cells you're holding and gaining share in, which I think at the global level was 56. Where do you think that number should be? Thanks.
I would say the higher the numbers, the better in terms of innovation. We were at 30%, we're at 31, doesn't make a big difference, but it's a good number in itself, I would say. If we can be at 33, 35, why not? I mean, it's even better. The higher the better, obviously. And we are working in order to get there, obviously. And what is important as well is what we have explained, I think, over these last 2 days, is the fact that innovation can take different shapes and form. It's not only about R&D, but R&D is contributing. It can be about marketing, it can be about system, which is the case of, for example, these Nescafé ambassadors. So which is, I would say, quite unique to a certain extent to what we do at Nestlé. Close to 1/3 of our products that are on the shelves today that were not on the shelves 3 years ago is, in my opinion, a good performance. Once again, we are trying to get at a higher level. The fact that we have 56% of our sales, both in terms of geographies and categories, that were either maintaining or gaining market share last year. Once again, it is 50% gaining, 6% maintaining, 44% going backwards, is it moves in the right direction. It is an improvement against where we were a couple of years ago. We obviously strive to do better as well. So, I mean, if we can be at 60, 65, whatever, it's obviously better, and we are working in that direction. But it's difficult to give a benchmark, but the higher the better.